Hey everyone, me Kevin here. I'm coming from the tropics. Actually, it's more of like a water park and kids place, which is really cool because it's Jack's birthday today. And we've got a little bit of a Kevin could be wrong piece here, which I always like doing. I always like having a balanced perspective of what's going on. And this is a really interesting one because we're going to dive into the unemployment rate and what the near term might look like and how that could affect mortgage rates, treasury rates, and quite frankly, the stock market. And it's a little bit of the counter to what we've been talking about and what we've been reading and studying. So I figure, hey, let's get into it. So this is from Pantheon Macroeconomics. And what they're actually looking for is a potential dip in the unemployment rate in the September release. The September release comes out September 6th. I would write down these dates. September 6th at 5:30 a.m. we'll get the August release. October 4th we'll get the September. Then on November 1st we'll get October unemployment release. Now what's fascinating about that is you'll actually get an unemployment read just 4 days before the election, which I wouldn't be surprised if we have some massive volatility right before the election, mostly because historically we do. We generally have extremely high volatility about the 6 to 8 weeks leading into an election, which would really start beginning technically calendar-wise after the September unemployment report that releases, or sorry, the August unemployment report that releases September 6th, but not if that report's good. And see, macroeconomics is penciling in a decline in the unemployment rate. And a decline in the unemployment rate from 4.3 to 4.2 could potentially untrigger the sum rule, some folks are suggesting, which would untrigger the recessionary warning. It'd almost be sort of like an early pre-fire. Now, I wanted to see why they thought this. And we've got a lot of details here because there's some big implications as to what this could mean. I do quickly want to add a little bit of color, though, because yesterday some people, they had some questions about the new financial advisory service that we're offering. Should be really clear, just a quick note on this. It's consulting, all right? We're consulting folks on how to build a wealth plan. It's not like we're trying to take their money and take bips and saying, oh, we're going to outperform the market. We could allocate you to VOO and to a balance of that, bonds and real estate, or whatever you're looking for. The idea is, how do we get you building wealth with real estate while balancing that with your income, your debt, your investments, your renovations with real estate, your acquisitions of real estate? That's the whole point. So if you want to learn more about that service, it's all over at stockhack.com. It's a new service we're launching October 1st, and it'll be licensed financial advice where we can actually create a real plan with you. And the cool thing is, we don't charge hourly fees, and we have a lower basis point fee than what you usually see, but we do have a monthly retainer that goes with that. So do check that out, learn that over at stockhack.com. Okay, so let's keep reading here. So the continuing claims data that we're getting right now has indicated that the 4-week moving average has actually declined from 238,000 to 232,000. So what I did is I wanted to line up unemployment claims with the unemployment rate. And they both lag the start of a recession, but they actually do align pretty dang well. So you have a very clear sort of, hey, when the unemployment claims spike, you do generally see a spike in the unemployment rate. So that association makes me agree with them that, hey, you know what? You could actually have a good payrolls report here for August, mostly because they're suggesting that a lot of the jump in unemployment we saw in the July report was, in their opinion, 40% due to temporary layoffs. Now, the BLS suggested that Hurricane Beryl did not impact the data, but rather these were potentially other temporary layoffs. A lot of people on social media were saying, oh, you know, it's because of the hurricane or the weather or whatever. That's not what we actually saw in the data. A lot of it had more to do with temporary layoffs in California. That was quite interesting. But anyway, unemployment due to involuntary job losses usually rises slightly more than the unemployment claims during labor market downturns because some people will be ineligible to claim benefits. Okay, so I wanted to dive into this a little bit. And so what they're saying here is, even though they think that the unemployment rate might drop, they do think that unemployment claims may not reflect everyone. And this is where I wanted to dig into a little bit who might not be eligible for unemployment claims And then the story shifts a little bit. Listen to this. Higher income individuals may be less, and this is my sort of note taking from other sources as well. So adding to this piece here, higher income layoffs versus claims. Higher income individuals might be less likely to claim unemployment benefits because they might receive a severance, they might have higher savings, there might be a negative stigma associated with filing for unemployment, which they might view as hurting their ability to get another job. They might have high confidence in themselves and their ability to get another job. They may straight up not be eligible for unemployment due to their prior income, or they may have other income. Now, what's fascinating about that is we look at this recession as potentially more white-collar driven unemployment layoff recession, which means unemployment claims wouldn't potentially capture a rise in white-collar unemployment, which I thought was very interesting. That's not to say that I don't agree with them. There is a chance we could have a September drop in the unemployment numbers, which would actually be really bullish. Markets might rally on that, and you might see the 10-year Treasury and some of the other Treasury notes go back to their 50 DMA. Their 50 DMA on the 10-year is currently over like 4.1, and we're at like 3.85 right now. So in the short term, betting on bonds could be in the short term a bad idea. If the jobs report comes in really good next month, we could end up seeing bets for a 25 basis point move from the Fed rather than a 50, which means we have to unprice more cuts. Remember, the Fed right now is sitting somewhere around, or markets are expecting and pricing in about 1.33 cuts. That would have to go all the way down to 1, and that might be a little painful for markets in the short term, unpricing that. But it could be bullish soft landing narrative until, and this is the next part, quote, consumption growth will slow slowly. Now, this is where we do have a little bit of bad news in this. So even though this piece is supposed to be, hey, Kevin might be wrong, I might be wrong here in the short term over the next month or two. But listen to this. The rate of growth in consumer spending, however, looks unsustainable. The only reason we've seen this sort of outpaced growth in spending has been because the personal savings rate was obviously very high during COVID. People had excess cash. Then they blew through that. And now the personal savings rate has actually fallen to substantial lows. In their words, that has only been possible because the savings rate has fallen to a very low level. The Bureau of Economic Analysis now estimates that the savings rate was just 3.3% in Q2, down from the previous estimate and well below the 2015 to 2019 average. A very low savings rate was unsurprising when the labor market was very strong and consumers were sitting on big stocks of excess savings built up by the pandemic. But the stock of excess savings has now diminished significantly, especially for lower income households. The ongoing softening in the labor market and the rise in unemployment, meanwhile, will probably lead to a rise in precautionary savings. That suggests the savings rate will rise markedly from its current low levels. Now, this is an interesting one because I wanted to take that and line it up with something else I noticed over at the St. Louis Fred, the data website. And the first thing what I saw when I saw it was, oh my gosh, first of all, they said, congratulations, it's Jack's birthday. And second of all, happy Labor Day weekend, everybody. We love y'all. Kevin has a Labor Day sale for the programs on building your wealth over at meetkevin.com. Go check him out. Obviously separate from the financial advice over at stockhack.com, but go check that out. Coupon expires Monday. Okay, so that suggests that the savings rate will rise markedly from its low level. So what I did is I went to St. Louis Fred and I lined up the spike in the savings rate. When does that usually occur? And usually spikes in savings rates after you had a low trough for a couple years, like what we talked about yesterday, occur within the first quarter of a recession. Some of the data we were looking at yesterday, like the spike in unemployment claims, usually occurs in the first third of a recession. So typically, neither of these are going to be a leading indicator for what recession looks like. Instead, what you're getting is, hey, confirmation that you're in one. And this also makes sense because as we start seeing the unemployment rate rise and people start getting more nervous that they might lose their jobs, they start saving more money because they're worried about a recession. That usually doesn't happen, though. That fear usually doesn't broadly hit people until you're already in a recession. This means, once again, and as usual, Kevin is probably early. In fact, I think there's a potential that you could end up seeing the recession. Well, first of all, I think we'll see a lot of election volatility. Election volatility you'll probably see mostly in October, I would guess, but end of September to October. After that, my take, and it's been this, my take has been that take advantage of the dip on election volatility and buy the dip in stocks, go long stocks in October volatility, if there's no sign of a recession yet at that point. So given that the jobs data comes out, the last jobs data comes out on November 1st over the next 3 data sets, even though I think that's lagging, what I want to do personally, and this is from sort of my portfolio, my positioning thinking, I want to look at, I sit on the sidelines, I like my bonds, I like mortgages, mortgage plays, but what I like as well is that we could be patient. That's my thought. September, October, November, let's get that data. After that data comes in, evaluate where do we sit with earnings. See, we'll have just gone through Q3 earnings in October. And what forecasts are we getting for Q4? If we have great unemployment data and we have great forecasts from all the companies reporting in Q3, that might, and we're still not seeing any other, craziness of recession, like some sudden decline in GDP or some black swan or whatever. If we don't have any of that bad news between now and then I'm gonna get more bullish soft landing and push me back to kind of that 7 range. However, if we have data, leading data, not lagging data, but leading data, whether that is an estimate of GDP forecast, the personal savings rate adjusting, people spending, consumption falling, forecasts from companies and earnings calls really saying, oh my gosh, we thought July was bad, you should see September, October, it's even worse, that's going to make me more nervous and more bearish. So this is just basically a way of saying, hey, your boy Kevin's going to be data dependent. Now, what else did I write down here? So they think that if so, consumption growth will slow much at a much weaker, if so, consumption growth will slow towards the much weaker pace of growth in real incomes. Our forecast is for consumption growth of just 1 to 1.5% over the second half of this year. That level of consumption growth, by the way, is recessionary. Now you're technically still growing slightly on consumption, but it's so low that you get layoffs, and that leads to the spiral of even less consumption. So it's kind of like this. It's like soft landing into a recession, like a really kind of slow down into recession, which isn't a surprise. I mean, a lot of people think we're already in a recession. I'm not convinced that we're already in one, but I think we could be at the early innings of one. But anyway, I think this is very interesting because it's a piece that does sort of say, hey, Kevin, in the short term, you could be wrong here. So just be prepared for that. I think it's worth considering that. In the longer term, they kind of reiterate my fears. But again, I'm going to be patient over the next 3 months. I don't mind sitting out the market at these, near all-time highs, although we are off all-time highs, somewhere maybe 7% below all-time highs, like on NASDAQ or specific individual securities that we've seen over the last few months. And so I'm okay with that. I continue to maintain that I think the upside is maybe 10%. At this point, I used to say 15%. I think now the upside is maybe 10%, and the downside is closer to 30 to 50%. Mostly because once people are, think about how fast it goes. And this is why I don't mind being early, because look at what happened October 5th. I know we had the carry trade unwind, but that came 3 days after the July unemployment claims, unemployment read. And the market just moved fast to start pricing in a recession. They're plummeting. And that's the concern, is how quick the market is to price that in. And when you combine that markets have already almost fully priced in the Federal Reserve rate cutting cycle, it just doesn't leave me a lot of hope for a lot of upside, at least not speculative upside. Combine that with where valuations sit right now and our boy Warren Buffett's selling. Apple, Bank of America, come on. Anyway, thank you so much for watching, folks. We'll see you in the next one. Consider subscribing. Just a message to all the supporters. I really appreciate you. Thank you so much. I know there are very few and sort of noisy people that leave disgruntled comments over, Kevin's selling something, that's a scam. It's funny, it's like, when did capitalism become so hated? I don't understand. Like, to me, I've always mentioned the goal is to provide value. And so, for example, with StockHack, our goal is, wow, how can we provide as much value for people? And it's not like, okay, send your money over, we'll custody it with JP Morgan and take some fees from you. That's not the goal. The goal is to actually look at your family situation and go, how can we make you retire better and earlier and more well off than you would have otherwise? That's what you're paying for. You're paying for a consultant, an advisor, right? A licensed financial advisor, really having a plan. If you want more, make sure to sign up over on the interest list at stockhack.com. At this point, it's not open. We'll open it October 1st. But yeah, I do think it's interesting how anti sort of capitalistic the world has become. I think it's just, I don't know if it's like social media and envy or what, but it's funny because you look at commentary sometimes, and you really shouldn't, but you can look at commentary and people are like, I just don't like the guy. It's like, okay, what did he do wrong? I don't know. I just don't like him. There's something about him. I just want to punch his face. It's like, okay. I mean, I want to punch my face too. All right, folks, we'll see you in the next one. Bye.